very little resilience in the system to deal with these shocks. And so that's what we need to be trying to build up in the country. And we haven't managed to do that. Despite all of the social spending that's happened, despite a lot of the service delivery that has happened, I mean, we say yes, there has been service delivery, but it has not been enough. It has not been adequate. And this kind of crisis shows those vulnerabilities.
Welcome, comrades. Finally, I am back after being load shed. And so we are starting now. I see Gamp was already calling. I was load shed in China. But now we are back. And so welcome everyone. And we are also live on Facebook Live. And so we welcome the comrades that are joining us there. We welcome the comrades that are joining us here as participants. Welcome Neil and welcome Comrade Taban, and we welcome all the comrades that are here. And today we are really glad as we are continuing with these particular engagements that we are trying to have, and with the kind of engagements that we are trying to have, and as these comrades were already just informally chatting, we've just seen this report that came out yesterday by the NEEDS and CREM on the impact of COVID on employment, and we've also just seen, some of us were sent earlier by Comrade Neil, the report by IEJ on economic recovery. I mean, almost all the figures that we seem to see, they are pointing to one clear issue of the massive impact. Obviously, the spark of this COVID, but we know that these actually are more pointing to a real deep structural crisis that we are as the country and as the economy, and the impact of it. I mean, when we mention, obviously, I mean, the NEEDS CREM survey obviously is one of the well-known, I mean, NEEDS already, they've always done very useful surveys. And so the figure of 3 million people and already 1.5 people that are followed, and obviously we know many of us here from our own different work that it's very likely that maybe up to half even of those 3 millions are likely gonna are just not gonna be temporary, but are gonna end up being permanent jobs lost, and so this is really a critical time. I was just listening on the radio this morning as I was driving my sons to school, and this representative, I think it was something called Mavuso, speaking on business leadership South Africa. And this guy went on and went on and went on. And by the way, interestingly enough, he spoke very glowingly on the treasury. And was blaming the government that the government seems to be dragged by ideologues who are not taking the real interest of the country and the economy at heart. How dare does the president announce a ban on alcohol without actually consulting business? And then he went on and effectively pointed this massive crisis, apparently because business interests seem to be not taking the primary priority. And so I mean, and so these kinds of these engagement are quite significant, you know, and they are useful in reminding us that this is a really treacherous and protracted battle. It's not a short battle, it's going to be a long one and protracted one, and that is going to require that we be resolute and that we really keep on, and really we expand the space and the avenues for the kinds of struggles, and also taking mostly from the comments from our engagement last week, which I think the culmination of last week's the last week webinar is essentially, which was the fact that it is going to be very important to actually discuss even broader what kinds of struggles then are necessary to essentially advance these kinds of things that we are saying that are now beginning to swell both academic, intellectual, but also even public opinion now. But how then do we move this from just academic text and reports to actually resonate with the actual struggles of our people, of workers, of communities, of civil society organizations, and various kinds of broad left formations, you know, because those are the things and those are the people that are really going to make a difference and that are going to give the momentum. And so today we are very glad that we have comrade Chris Malikane, and he's quite a well-known economist, and so we are quite excited to hear his presentation, and so we will do as usual. And by the way, as we always do, we would like to just request that the comrades that are here on the panelist list, those we just mute our microphones, and then we will then unmute them when you are given a chance to speak. And without much further ado, I would very much like to welcome Comrade Chris to take the podium.
Good evening, comrades. I hope that you can hear me. Can you hear me, comrade?
We can hear, but we can't see.
Yes, we can hear you.
Oh, okay.
Exactly, PSG. So I was surprised you were calling me to order about a radio I don't have.
Comrades, can you see me now?
Yes, we can see you now.
Okay. No, thank you, comrades, for giving me this opportunity to talk about this important issue, which is basically to begin concretizing what an alternative macroeconomic policy framework is supposed to look like. Because what has happened is that we have been very strong in criticizing the neoliberal macroeconomic policy framework, but in putting forward a framework that is supposed to replace it, then we've not been, I think, story. So when comrades talking about the need to maybe abandon inflation targeting, but replace it with what? The need to have an expansionary fiscal policy, but financing it with what? You know? So it's very important that we begin to clarify and crystallize our ideas into a coherent framework. So that is what I will begin trying to outline in this presentation. So let me perhaps share my presentation here. Can I, Comrade Stay, can you please allow me the right to share?
I've just done it now.
Okay. I'm just looking for something to point. Okay. So that's the topic that I'm supposed to talk about, macroeconomic policy for transformation. Let me go down. Yeah. I was struggling with this thing here. Okay, so that's how I'm going to be structuring my presentation. Just to put forward a context, because what we have is a situation where the economy is suffering from slow growth, and this low growth hardly mention is made of profitability. And as I will show in this note, profitability plays a very big role in driving economic growth, yet it is not mentioned in mainstream discussions. And what is the relationship then between interest rates and profitability as they relate to economic growth? So that's the story. It's important because interest rates, we know they are set by the Reserve Bank, and that begins to talk about monetary policy. So the argument I will be making is that the way in which the central bank has been setting interest rates contributed to the slow growth that we have experienced. And then outline of the current macroeconomic policy framework, and also the associated financial architecture that accompanies the current macroeconomic policy framework. The argument there being that even if we want to change the macroeconomic policy framework, we can't do that without changing the institutions which govern the financial system. So at this point, then I limited myself to looking at the structure or the architecture of the financial system in South Africa. And then the argument being that we need to change. If we change policy, we need to change the architecture. If we don't change both, then there will be limitations in the way in which we can control the development of the economy. And then I present the alternative macroeconomic policy framework and what I consider to be the alternative financial architecture, and then respond to some critiques of this proposed macroeconomic policy framework. So as I mentioned before, I plotted 3 variables just to give context. There's a paper I wrote around 2017 on profitability in the South African economy, where I basically calculated the rate of profit of the South African economy. This is important because, as you comrades might be aware, fully aware, in classical political economy, particularly Marxist political economy, the rate of profit is a crucial variable in the capitalist system. So if we want to understand what's happening to the capitalist system or what is likely to happen to it, we need to look at what is happening to the rate of profit. without understanding the dynamics of the rate of profit, then it becomes difficult to understand the pulse in the capitalist economy. So the blue line is the estimate of the rate of profit in the South African economy. I used quarterly data to do that. And then the red line is the long rate, i.e. the interest rate on 10-year government bond rate, bond instrument. So this red line then is the 10-year government bond interest rate. It's what is sometimes called the long rate, because it is an interest rate on a long-term debt instrument. The instrument being short means that it is for less than a year. And if it is long, it is more than a year. So this is a popular measure of long-term interest rate, the 10-year government bond rate, the R153 or something like that. And then the rate of profit is the blue line. So if plotted alone, the tendency of the rate of profit to fall comes out very clearly, as Marx noted a long time ago. And then this green line here is basically the growth rate of the economy. So the point that I want to make is that if the rate of profit is above the interest rate, there is some incentive for capitalists to accumulate. This gap between the rate of profit and the long-term interest rate is what Marx calls the profit of enterprise. So it roughly represents the profit of enterprise. But to calculate it properly, you would have to take a weighted average of funds that are internally generated by capitalist firms vis-a-vis the weight that a capitalist firms place on financing. So this is a rough measure. This gap here becomes then the rough measure, a very, very rough measure of what Marx would call the profit of enterprise, i.e. the difference between the rate of profit and the interest rate. So you find it in this gap. You find it used in models, macro models, in heterodox post-Keynesian models that are associated with authors such as Michael Kalitsky and John Robinson, Nicholas Caldo, and others. So as long as the rate of profit is above this, there's an incentive for growth to be high, because capitalists have an incentive to accumulate rather than keep money in financial instruments like bonds. So once this thing, the rate of profit falls below the interest rate, then there's pressure for the growth rate to go down, slow down in the rate of capital accumulation, and hence the growth rate of the economy. As the gap closes, the rate of profit, the growth rate of the economy begins to recover if you look at the trend. And then once again, as you can see here, the years, my argument is that because the rate of profit is below this long-term interest rate, it means that there's no incentive for capitalists to accumulate. Hence, that depresses the growth rate of the economy. So one of the things then that comes out is that there is a need perhaps to compress this, whilst at the same time lift the rate of profit in order to, if we want growth to pick up. And that is the challenge that we are facing. So those that argue that monetary policy cannot affect long-run economic growth, in my view, I think they are mistaken, because it does through influencing the rate of capital accumulation. And then, so what I've done crudely, I simply took the rate of profit I minus that long rate. So this is a measure of that gap. It's a crude gap. And then plotted it again with the growth rate so that comrades can see how this profit of enterprise measure actually maps the tendency or the central tendency of the growth rate of the economy. So as the growth rate of the profit of enterprise recovers, so does the growth rate of the economy. When it tanks, the growth rate of the economy also tanks. So you can see here it's negative because it's a crude measure, right? If it's measured properly using those weighted averages I spoke about, then it would not tank this level. Perhaps it would go to even a slight negative, but not such a big negative. But just to illustrate that indeed the growth rate of the economy is driven by that gap. Okay. So if argument is that if somehow the central bank were guided by this gap, it will try by all means to at least align the interest rate to the profitability of enterprise to ensure that the rate of real capital accumulation takes place. Okay. So maybe here I should talk about something. So when Treasury talks about structural reforms, basically what Treasury is trying to do is trying to lift the rate of profit, or is trying to lift this profit of enterprise by increasing conditions for profitability of the system. But at the same time, Treasury does not want, in the Reserve Bank, they don't want to touch this. They want this to be driven purely by market forces. And the argument here is that monetary policy, by closing this gap, it can go some way in boosting or in arresting the rate of decline in capital accumulation. And then, but also it poses a question to the left to say, what measures should be put in place to also recover the rate of profit? If we agree that we will be operating in the capitalist system for a foreseeable future, then there is a need for us to begin contending with this and then come up with our own version of a structural transformation, not structural reforms, but structural transformation to maintain, to recover the rate of profit. So that is the question that we should be grappling with as well. So here is the current macroeconomic framework explained in a nutshell. So basically, Treasury cries about the debt capital, the debt GDP ratio, but the debt GDP ratio is driven by this deficit, was primary deficit. This is government spending minus taxes. So that deficit drives the increase in the debt capital ratio, because if government spends more than it collects in taxes, the argument is that drives the debt GDP ratio up. And then another factor that drives the debt GDP upwards is the interest payment on existing debt. So this part here then explains the interest payment on existing debt. This is we can think of this as the interest rate that government pays on existing debt. This is inflation, so that this is the real interest rate that government pays on existing debt, minus the growth rate. So it must be growth adjusted. That's the law of, what we call the law of motion of the debt GDP ratio. So this law here is a fundamental law that governs fiscal policy. Okay. So what Treasury has done is to say, okay, if we decide to increase government spending in the context where taxes are low, then in fact we'll be running a deficit. So this deficit will have to be funded. So government will have to mobilize funds to fund this thing. How does government do that? Government will have to issue more debt. Will have to increase public debt. At the same time, government will have to pay interest on existing debt. Okay, so it's a fiscal policy framework that they've chosen that says that to fund deficits, you have to borrow. Government has to borrow. And the borrowing is at market-determined interest rate. So this is the lending rate that government will pay on its debt. If we want to reduce this debt GDP ratio, then we need to do two things. One, we need to cut government spending, austerity, try to run a surplus here, right? So if we cut government spending here, so that government spending at least is below the taxes that are collected, so we'll have a negative there. So that is going to spill over and reduce your debt GDP ratio. So that's the story. That is austerity. The second way we can do it is to stimulate economic growth. Is to increase economic growth. Don't touch the Reserve Bank here. Don't go there, because now the Reserve Bank needs to be independent and all of that. So whatever happens here, don't touch. What we need is to touch here or try to do something here. And what we need to do here is to implement what they call pro-growth policies. So they got these nice terms for the policies that they come up with. It was inclusive growth, pro-growth, and so forth. So pro-growth policies are policies now that are aimed at increasing this, as if the other policies are not pro-growth. But so the idea then is, in order to do these pro-growth policies, then you have to engage in structural reforms. Because once we do structural reforms, their thinking is that it's going to increase the profitability of the enterprises and therefore drive this growth above the real interest rate, and therefore reduce the debt GDP ratio. So we need to do both. There's no way around this. We can, if we do one, it's going to be very extreme, very painful if we cut a lot here. They do acknowledge that. So we need to combine structural reforms and austerity, at least balance, but the whole aim is to reduce the debt GDP ratio. Okay. So that's the story. Hence the governor, the deputy governor of the Reserve Bank also said we have to reduce the deficit, whether we like it or not, right? And the Minister of Finance has come out guns blazing, saying that we have to implement structural reforms to stimulate growth, because we can't spend our way out of the crisis, because he's afraid that if we increase this, it's going to explode the debt and government might default. That's his argument. The second point about the framework is that, so the main point to take there is that deficits are financed primarily through borrowing. That's the financing strategy, okay? And that the interest rates that government pay should be market determined. And the only way to manage fiscal policy, i.e. in particular the debt GDP ratio, is either we have a low deficit or pro-growth strategies, or a combination of that. But the borrowing costs of government, right, are basically driven by the short-term interest rate, right? So this rate here, this interest rate is the interest rate that is controlled by the central bank, right? The central bank easily controls the short-term interest rate, the repo, but usually there's a number of interest rates that the central bank affects in controlling the economy. But we'll think of the current short rate, this R here, being under the control of the central bank. These are basically expectations of future short rates, right? they also determine the borrowing costs, right? So if markets expect interest rates to increase, the long rates or the lending rates, government will tend to increase as well. And then lastly, there's this risk premium, right? So the risk premium is determined by a number of factors. These factors could be, when you get downgraded, this thing is supposed to go up and therefore increase your borrowing costs, which comes here and destabilizes your debt because now you pay more interest on debt, which pushes up your debt GDP ratio, right? So if you keep on increasing your debt GDP ratio, that tends to increase your risk premium, which increases your lending, which makes your borrowing costs expensive and therefore makes your debt GDP ratio to rise. As it rises, it comes back, it feeds back to your risk premium, increases your borrowing costs, and so forth. So it becomes a what they call a debt spiral. I think it's the Minister of Finance who used the term. You have a debt spiral. Okay. You have a debt spiral. So the role that the central bank can play here is through this R, and this R is determined by, we know, inflation targeting. The central bank simply sees if expectations or inflation expectations are higher than the target, then the central bank will increase interest rates, and then that will feed into your lending rates, as government, and then it creates that spiral. So we've got monetary policy here, which is inflation targeting, and then it's mediated by financial markets, bond markets here, which converts this short rate into a long rate that government is charged on bonds, and then these then feed into your debt GDP ratio, your fiscal policy, and then goes like that. So what's the story? The story is that if you keep inflation low, right, close to the target, then interest rates are going to be very low. Then the central bank will cut your interest rates, they are low, that reduces the borrowing cost of government, and that stabilizes your debt GDP ratio. That's the story, right? So low inflation, low lending rates, low debt GDP ratio, right? So, but in achieving low inflation also, we need to not to be too aggressive with government spending, because if government spending becomes too high, then it creates inflationary pressures, which pushes the central bank to increase interest rates, which increases lending rates and so forth. So you can think of this system as a system of disciplining government from being too aggressive, adopting a too aggressive fiscal policy. So fiscal policy should be gradual, not inflationary, and that way there's going to be stability. Okay. You can only be aggressive if it's the growth rate is high to allow a space for you to do that. So this is a fiscal framework currently, how it links is structured. Okay. So this lastly, let me talk about this. This is think about this as a measure of slack, or what we call excess demand in the economy. So when we say, some comrades argue that no, the central bank should also target output, or should also target growth. The central bank always says, but we do, we do target growth. And it is this term that they talk about. So they do, if you do statistical or econometric analysis, you will find that they do react to growth, which is measured by the output gap. If there's excess demand in the economy, they do lift the interest rates. If there's a slack, they reduce interest rates. But the issue is not whether they react to this or that. The issue is these parameters here, is the weights that the central bank places on growth versus inflation. It's about weighting the two objectives. Sometimes we put unemployment here, as a target. Hence, the ANC, the resolutions of the ANC was saying that we need to broaden the mandate of the Reserve Bank so that it also targets unemployment or it targets growth. I mean, it's old resolution from Polokwane. But they do. The issue is that they place more weight on inflation because the Constitution says that the primary mandate of the Reserve Bank is price stability. So they interpret that to mean they must react more to inflation deviations from target than to output deviations from target. Okay. So that's the story. That's why you find in the Monetary Policy Committee statements, the central bank does not talk much about the output gap or unemployment rate. It's more inflation. They are focused on this because they consider this to be their overriding objective, right? Of course, it's supposed to be in the interest of balanced growth, but they are saying that their primary mandate is here. This becomes secondary, less weight. Okay. So this is the framework in brief. So the institute, the financial architecture that underpins this, or the flow, let's call it the flow that underpins this framework, is that monetary policy sits there, and then the Reserve Bank uses the short-term interest rates to control the long-term interest rates, to influence the long-term interest rates. The long-term interest rates, in turn, affect public debt accumulation, right? And in turn, public debt accumulation affects long rates because if government issues bonds, that tends to affect the interest rate that government gets charged, price of bonds themselves. So there's a feedback that exists here. And also by influencing the long rates, the central bank also influences private spending. Investment, consumption is affected by the interest rate, the credit, the lending channel here. On the other hand, we know that government spending, that's fiscal policy now, government spending and taxes, right? So if government increases spending, that spending is going to add to private spending, and then it will affect the unemployment rate. And movements in the unemployment rate affect inflation, and inflation feeds back to monetary policy via our inflation targeting framework. The central bank does, as I mentioned, react to unemployment, but I put dotted here to show that the reaction is mild compared to the reaction to inflation. So that's how it works. And if that is too much, then government starts to want to fiddle with the deficit to create austerity. This could be thought of as an austerity feedback to try and control that. Okay. So that's the story. Fiscal policy is separated from monetary policy. And sometimes the central bank conducts monetary policy by directly purchasing bonds that exist in the financial system. And so if the central bank were to buy bonds through what is called open market operations, the impact of that would be to lower the interest rates here, the long rates. And then also that is going to have an impact on public debt accumulation. Before COVID, the central bank or the SAP had something like 8 billion rands worth of government bonds. And we know that the SAP, according to the SAP Act, it's supposed to remit some of the profits to government, right? So this could be some revenues coming here to add to the taxes. But they've not been doing that. They've not been aggressive in doing open market operations to acquire government bonds from the bond market. And that has meant that government has been getting less than what it should have had the SAP been more aggressive in buying government bonds. And the impact of these, comrades, is fairly straightforward. as you can see. If 90% of the profits of the Reserve Bank are remitted to government, then if the SAP were to increase its ownership of government bonds, it will basically reduce the long-term interest rate and by implication, refinance government by taking 90% of the profits that it would have made from ownership of government bonds. So it would cancel about 90% of the interest payments that government is supposed to pay for its debt. Because of that, then the SAP decides not to aggressively acquire the bonds and allow the bonds to sit with the private financial systems so that the private financial system can make the profits from public debt. Okay. So comrades can stop me if so. Here again, I read the Treasury documents. It's not clear, but when we talk about fiscal policy, you would expect that there should be a target of the primary balance. Usually they set the target in the form of a forecast. We expect the deficit to be 4% or 6%, the public debt to be 80% of GDP. Inflation target, this is a monetary policy target now, is 4.5%, between 3 and 6%. And the unemployment rate target is not there because the SAP is not, unemployment is not part of their mandate. And also they believe that they can't target unemployment. Okay. So that's the story. And then the architecture is like this. This is like a circuit for engineers. It's like a circuit of the electrical system, electrical circuit. So basically, the SAP is sitting here. The SAP interacts with commercial banks in the secondary market where there's a buying and selling of government bonds that have been originated in the primary market where the SAP does not play a role. So government here runs a deficit. It needs to borrow according to the fiscal framework. It borrows from banks and from pension funds. So these are the players in the primary market. The SAP is not here. So once they bought the bonds and determine the coupon rate that is charged on government, then they start trading bonds amongst themselves, and the SAP really sometimes, as I mentioned, plays a role in the bond markets together with the commercial banks and pension funds. This then creates a wall, right? A wall between National Treasury and the SAP, the so-called independence between monetary policy and fiscal policy. And the only link really that exists in terms of financial flows or money flows is when the SAP makes some profits and transmit it to the SAP, to the National Treasury, as per the SAP Act. And then what you have then in the system, underneath this system, you have all these institutions. I decided to just focus on state institutions. IDC, Land Bank, DBSA, Central, the state-owned, the DFIs, right? And the state-owned enterprises are sitting here. They are not borrowing directly from the SAP, but they are borrowing from the secondary market, from the banks, commercial banks, and from the pension funds, right? That interest rates determined by these institutions or by this so-called market, okay? So all the debts that are here are guaranteed by National Treasury. Sometimes National Treasury, through specific departments, allocates directly to state-owned enterprises and DFIs. Okay. But National Treasury, where does National Treasury get the money from? Gets the money from the banks. It gets the money from pension funds. And in return, they own government bonds, these institutions, which they, like I said, they can trade amongst themselves. So the link in terms of financing here with the SAP is not there. So hence the interest rate that is charged here, or that these institutions pay, is a market-determined interest rate. Even if they have a developmental role to play, but they have to pay a market-determined interest rate. Even if part of their expenditures are transfers from national government via the national treasury here. The fact of the matter is that national treasury itself pays market-determined interest rates to allocate to these institutions if there are some allocations that have taken place. And then on the basis of that, access to credit and the pricing of the credit, then you've got all these activities now: manufacturing, agriculture, infrastructure, roads, etc., right? And these, in performing these functions, we expect these DFIs and SOEs to be driving broad-based industrialization, black economic empowerment, meeting basic needs, and creating mass employment. That's what we expect on the basis of this financial architecture. And the argument is that it's not going to work, especially if we have these historical backlogs that we need to address. Okay. So what we see here then is that reconstruction and development is subordinated to private finance, right? Banks and pension funds, and sometimes I did not mention foreign lenders, but banks and pension funds, they are the ones that that determine the allocation of funding to these institutions. So there's no distinction made between financing development and financing luxuries. So you might find that it's cheaper to finance a mall. The mall can be financed at a lower interest rate because it is perceived to be less risky than to finance an SOE like Transnet. SAP plays no developmental role whatsoever, contrary to development-oriented economies. So if you look at other economies, Southeast Asian economies, India, Pakistan, even Brazil, some Latin American economies, you'll find that their central banks have got specific links with development finance institutions and state-owned enterprises, which is not the case with SAP. The only thing that SAP is linked to is land bank paper. So if land bank, for example, borrows from banks, it issues their commercial paper with the banks, and the SAP can accept the commercial paper of the land bank as collateral when it lends to some money to banks. But other than that, the rest of the institutions here, they don't have a direct link with the central bank. So does not play a developmental role whatsoever. Too much public financing placed on the shoulders of fiscal authorities. You see, so what is happening here is that instead of, because all the debt that is here, right, is guaranteed by Treasury, and spending, even Treasury borrows to allocate funds here, and other infrastructure that is not driven by SOEs, like infrastructure by provinces, municipalities, and so forth. They use that infrastructure. Even government departments like education and health, public works, they do have some huge infrastructure funds that they get from National Treasury. But the problem is that huge infrastructure spending would not, in a developmental setup, my argument is that it would not be sitting largely with the National Treasury. Actually, to be funded via the Reserve Bank, with government giving a mandate on how the funds are supposed to be spent, giving priorities to SOEs and to all the infrastructure agencies, including departments. So it's not surprising for me sometimes to see the debt exploding, or the debt being high, if they say it's high, or there's no service delivery, infrastructure is not delivered adequately and at a faster speed. Part of the reason is that too much is placed here thinking that we can finance all infrastructure here and not using this and not using that, and not even using this, right? So that's the problem. The state is dominated by private finance. Basically, if you check in that framework, you'll see that basically national treasury relies on banks and pension funds to be funded. So when they cry about investors being downgraded and so forth, it's precisely the pension funds and the banks that they're crying about. Yet the banks are getting a license from the treasury to operate, and the pension funds as well, you know. So the state is now, or the government is held at ransom by private finance. And then, and that of course means that the power relations are skewed against the democratic government. Implications for fiscal policy: government spending then gets constrained by conditions set by private finance. For an example, there was an instance, I think around 2012, 2013, 2014, where one of the asset managers, I think it's Future Growth, refused basically to fund. I think it was ESCOM or SAA or Transnet, but they simply refused to fund, right? Some of them, particularly the banks, have even said that they are going to refuse to fund any energy, energy infrastructure or energy activity that is involving coal, carbon. We need to decarbonize, so they cut finance towards that, So forcing government to do some, what you call this thing, some transition, transition towards a low carbon economy at the pace that might be faster than we could cope with. Implications for service delivery and dealing with inequalities: there will be a slow pace of delivery, because if government were to be aggressive here, were to be aggressive in spending, this is going to, the deficit will be high, and this is going to drive the debt, and that is going to drive the long-term interest rates, depress spending, and increase unemployment. That's the logic. So the reason then is that government spending needs to be sequenced, must be very slow or in keeping with inflation control and debt control. Implication, okay, overall competitiveness. Profit of enterprise remains smaller, constraining the rate of capital accumulation. So in my view, because of the high interest rates that are charged on government bonds, that also feeds into interest rates that even companies pay when they borrow to finance their own capital accumulation. Because you can't have, in a free market system, you can't have the interest rate that is charged on government bonds being lower, being higher than the interest rate that is charged on companies. So the law is that the interest rate that is charged on companies in particular, will be higher because they are riskier than government. So the higher the government interest rate, it creates a base for interest rates to be high in general, including mortgage rates and so forth. And that eats into the profit of enterprise, slows down capital accumulation. So we need an alternative framework. And this alternative fiscal framework, then briefly, I'm going to say, it's the interest rate that government borrows will be made up of a number of interest rates coming from different instruments. Part of the financing of government fiscal policy will be from the open market, normally, as is currently the case, but that will be a certain weight. It won't be 100%. Part of it will be from prescribed assets, right? Because we need to impose prescribed assets on the financial system, banks and pension funds. Part of it will be through direct financing by the Reserve Bank, where the Reserve Bank can issue zero coupon bonds and low interest bonds and so forth. A number of instruments can be put in place to finance government spending, to depress, to reduce the interest payment, and to stabilize the debt GDP ratio. Right? And another one, which is creating a furore, is direct money financing by government, by the central bank. So what you have then is a situation where government does not have to borrow all the time, or all of its does not have to borrow to finance all of its spending. So
Yes.
part of
Okay, just hold on.
Sorry, Comrade Chris, I think someone is not muted. I think someone just joined late and didn't mute.
okay.
Yeah. So maybe if you can be concluding within the next 7-8 minutes.
Yeah.
Sure.
Sure. So basically, you can do money financing, combine it with some bond financing using different instruments, like zero coupon bonds. You can use prescribed assets, which is at a lower interest rate. And all of that is going to reduce the interest cost of government and help to stabilize the debt-to-GDP ratio. And also open fiscal space for government to run deficits without raising debt. Similarly, even your market, the borrowing costs, right? The long-term interest rates, they will be determined as normally is the case, but there will be some factor, what I call a transformation factor, that will play a role in depressing somebody's.
Alex, I think it's
Yeah.
fine.
Okay. So in depressing this low rate, and I'll explain this, and even the monetary policy, in my view, whilst it can target inflation and unemployment, it can also begin to respond to movements in the rate of profit, so that we always have to keep in mind the fact that we need to keep a healthy gap between the interest rate and the rate of profit. Okay, so different from the other flow, the red flows here are basically the flows that we would expect from the transformed macro policy framework. So firstly, we said that there needs to be an expansion of the mandate of monetary policy to increase employment. So we need a strong link between monetary policy and the unemployment rate. We are not discarding inflation targeting, right? But what we are saying is that inflation targeting and the unemployment rate need to be placed on the same scale. Similarly, the access, the cost of borrowing, particularly by the state, then it needs to be targeted by monetary policy through these open market operations, which currently are taking the form of what they call quantitative easing. So there needs to be a more responsive monetary policy to unemployment and to control the long-term interest rates so that they are not simply moving under the influence of financial markets. We are saying as well that there needs to be direct lending at below market interest rates from the central bank in order to stabilize public debt and to open space for fiscal policy to be expansionary here. Money financing as well should be used. I mean, in other countries, it's called ways and means. India has got this, Malawi has got this, Uganda has got that, and so forth. And then another component, which is hardly mentioned, is this prescribed assets, which should be applied in the whole financial system, including the banking system, not just insurance companies. Again, at below market interest rate, that will go a long way in stabilizing public debt. So all these red lines are new things that are supposed to happen in a changed macroeconomic policy framework. Then the links, many links have to be created. Whilst, for example, we say that these institutions can continue to borrow from pension funds and from the commercial banks. Now, new players are in the picture. We need a state bank to come and play a role. Together, I argued elsewhere that we need this state insurance company to play a role in disciplining these private insurance companies. So this market now will have new players. And the impact of this is that when National Treasury issues bonds, right, these institutions will play a big role in determining the interest rate that National Treasury plays. In Brazil, for example, they've got the Banco do Brasil, which is a state bank which controls 60% of banking assets, total banking assets. So if Banco do Brasil, which is owned by the state, charges government a certain interest rate on bonds, then basically it's like the state is controlling the interest rate that it pays, you know. The same thing is happening in India and other countries where state banks are present. Similarly here, insurance companies as well, you need a state to play a role here. So much as other countries can boast and say, no, our national treasury is separated from our reserve bank, you find that they've got state banks that are actually financing the very same national treasury that owns them, okay? So that's what needs to happen. And the Reserve Bank needs to now have direct links with the Land Bank, the PSA, and so forth. Right? It needs to open a window to borrow, for these institutions to borrow at interest rates that are comparable to the interest rates at which banks are borrowing. Because these two are development finance institutions. This is where they are development finance institutions. They operate sometimes to support areas where even private commercial banks would not go. So you need these institutions to be linked to the Reserve Bank. And this can be easily done because the institutions are already there. It's just that they are not wired correctly. And I think that with this new setup, then we can have more economic activity without being constrained by access to finance. I mean, right now, if you take, for example, Eskom, regardless of the things that cause the debt in Eskom to accelerate, but as matters stand, with 400 billion rands worth of debt paying 12%, it means that per month, Eskom is paying something almost 4 billion rands of interest, you know, when in fact, that could be reduced by direct funding from the Reserve Bank. So lastly, this is the last slide. There are criticisms of this framework. The first one is that the new framework will cause inflation or even hyperinflation. Two arguments. One, the spending that we're talking about, the financing that we're talking about, will be financing to support largely the supply side. Okay, of course, it will have demand side effects, but in the medium to long term, it will boost the supply side of the economy and therefore bring about disinflationary pressures. And secondly, the proposals here are implemented in a number of countries already. For example, Brazil is implementing some of them. We go to India, they've got these things, and the inflation rates there are very low. I mean, they're comparable to South African inflation rates. Yet the growth rates are higher, the unemployment rates are lower, you know. The proposed framework will distort financial markets because there will be misallocation of financial resources and slow down economic growth. And the argument is that we can't rely on financial markets to fund development, to drive development because of uneven development in the country. I mean, there are areas and people in the country that have been deliberately sidelined from the mainstream economy that needs to be brought into the mainstream. So there needs to be interventions to address that. That is on its own, they call it a market failure in the mainstream. It's a distortion in the entire economy that needs to be corrected. There will be fiscal irresponsibility by government. This statement is mentioned by Deputy Governor Kuben in one of his articles. There will be reckless spending because there's cheap money, there will be corruption, and the money will be used for campaigning, you know, on the eve of elections, excess spending, and after elections, you reduce spending, creating what they call political business cycles. But the argument here is that the accountability and transparency in the whole process should be done in much the same way as budgeting is done in South Africa today. and which means that public representatives in parliament and civil society will have to play a very much big role in ensuring that the funds are used in a productive manner. The independence of the SARB would be undermined, raising risk premium and inflation expectation. Well, like I mentioned, there are countries that have implemented this. They've got low inflation, low risk, and they are more, in fact, they're rated more independent than the SARB, right? And the framework will erode macroeconomic credibility. On the contrary, the framework that we propose will lead to more control, more stability, and more control by policymakers of the allocation and movements of credit in the system, right? Rather than relying on private banks and pension funds that are run along profit-making principles. So, as Ken said, there's a need to socialize investment, because if you let investment to be financed by the private financial sector, it will be too volatile and create instability. On the contrary, so there will be capital flight and a currency crash. Well, there's no capital flight and currency crash in the economies that I just mentioned, like India, Brazil, and so forth. They're implementing these things. Even Turkey has a long history. It has state banks, that are running the financial system heavily. They play a very big role, bigger than actually the private banks. But if there is a currency crash, it's not because of this. It could be something else. So the institutions that we're proposing, institutional setup that we're proposing, is different. It's the same as that, and it's not uniquely susceptible to capital flight. But one thing that we need to underline here is that 40% of government debt is foreign owned. And one of the things that we need to be calling for is a progressive reduction of that foreign ownership of public debt, so that we secure sovereignty, policy sovereignty. I mean, the Indians are clear to this day. They are clear that they want 100% of their public debt to be Indian owned. Okay, thank you, comrades.
Thank you very much, Comrade Chris. This is quite a very educational session for many of us, and it was good that you actually engaged with it, because the diagrams themselves and the figures were leaving some of us with our heads spinning, and so it was quite good that. But the presentation itself has been quite clear. Are you able to remove then the share screen, so that then it can go back to show the participants as a whole?
Okay.
And now we're just gonna start with the questions. I already have one here from Facebook from Godfrey Ngubeni, who is asking that is it possible for the SARB to set a higher inflation target of higher than 6%, given that the most weighted variable in the inflation basket has been the cost of production? And then he continues to say, two factors are important for consideration. Oh, sorry. Okay, so where is it? Two factors are important for consideration. There is already depressed wages and relatively low oil prices, which are likely to have a deflationary impact on the inflation, at least in the foreseeable future. So that's Godfrey Ngubeni. Abongile Tsotsi, who is a participant here, is saying, is asking, on the other hand, Professor Malikane, the point you made about South African Reserve Bank's lack of development role or no role whatsoever is very interesting. And thinking about other parts of the world where central banks play such a critical role in development, the question then is, why SARB's plays so limited developmental role or no role at all? Is it the regulatory framework that prevents SAP to do so? If that is the case, in this case, maybe, is it because of Treasury very robust involvement in such, or there are other underlying reasons? And then just the third one, and then maybe we can give back to Comrade Chris to just respond to this. There's one by Comrade Rasigan here who's saying, excellent presentation, Comrade Chris, clear and lucid. The focus on profits and capital accumulation is critical in our contemporary conjuncture. Your exposure of some of the internal dynamics that are not necessarily easy to discern from a position seeking to transform the very logic upon which the axioms are pre-configured, and is very much appreciated. Assuming that the laws are premised on an analysis of the actual institutional evolution, what are the possibilities of coordinated development if the framework is rigged against such progressive outcomes and seems primarily aimed at constraining government and public sector interventions? Maybe you can just answer these three for now, and then we'll go to, there's more even coming in now.
Yeah, maybe let me start with the SAP setting a higher target for inflation. The logic why the inflation target is 4.5% or between 3 and 6% is premised on the fact that we need to look at the inflation rate of our trading partners. So if our inflation rate is 4.5% and that of our trading partners is 4.5%, it means that we are basically more or less competitive or comparable to our trading partners. If our inflation rate were to rise above that of our trading partners, then what's going to happen is that our exchange rate will be destabilized, or it will tend to permanently depreciate. That's the law. So the inflation target is actually coming from the inflation rate of our trading partners. That's where it comes from. If we deviate from that, it could lead to a situation where the exchange rate is permanently depreciating, right? Now the question is, how correct is the current inflation target? Is it reflective of the inflation rate that is consistent with the stability of the long-term stability of the exchange rate? That's the question that we need to investigate. Perhaps scholars and researchers can engage in that, right? But there are suspicions from some corporates that the inflation target might be lower than it's supposed to be. Okay. Then the second point was about why is the SAP playing such a small role, right? So the SAP, in my view, it's a political economic question, because as matters stand, if the SAP were to take some of the role of lending to development finance institutions and to state-owned enterprises, what is going to happen is that the SAP will be taking a very lucrative financial market from established banks and pension funds. And that is going to lower the returns that banks and pension funds are going to have, because the SAP will be financing DFIs at an interest rate that is equivalent to that at which it lends to the banks. So it's like DFIs will be going straight to the wholesaler to get the product, rather than the retailer. So the SAP, in that sense, by not playing that role, it opens space for profit making by these institutions. But also, the SAP is owned by these institutions. So sometimes the decisions that the SAP is making or refuses to make are informed by that. You find that if you look at the share ownership of the SAP, the banks, they own a small share, right? Because there are other shareholders. But the influence that the banks have, I mean, if I'm a shareholder in the SAP, right, and there's FNB representative speaking, I will be very reluctant to oppose because of the power relations that exist outside the general meeting, you know. So there is influence, heavy influence of banks in how the SAP operates, even if it claims to be independent. But the big thing is the political economy one. If government were to, I mean, currently, I'll give you a picture. Currently, the banks hold about 500 billion rands worth of government bonds. Government is paying about 10% per annum, right? Which means that the banks are making something like 50 billion gross, 50 billion rands return, right? So if half of that, if the Reserve Bank decides to buy half of that from the banks, it means that almost half of that 25 billion is gone. 25 billion rands worth of return is gone from the banks. So that's the political economy argument. And that's the underlying reason in my view. And Comrade Rasika, it's true that the system is wired in such a way that the democratic government is held hostage, is held at ransom. Even the so-called economists out there, I mean, the ones that dominate the mainstream media, they reinforce this thing, which means that whilst we might have alternative views on how this thing must be structured, we need ultimately to connect with the organization. We need to connect with the organizations of the working class and civil society to bring about policy change, you know, the type of institutional structure that we want. Without struggling, this existing structure won't change. I think organization and mobilization is the key.
Thank you, Comrade Chris. There's also one more question now that just came before I'm going to open for, I see their hands already. Can you hear me, comrades?
Yes.
Okay. There's one here by Ayanda Mdleche. Does the introduction of a state bank become necessary when you allow the SAP more free role for some government spending like infrastructure? And then secondly, he's asking, does the introduction of a state insurance, will that not be seen as a step too much into interference? Khadi, please just read again the question, the second follow-up question by Godfrey.
Okay, it says, and is this thing called transmission mechanism a reality or an illusion? And then he says, was it not, I guess he wanted to say, has it not been dealt with, the financialization phenomenon that has been happening, such as the divide between the real economy and the monetary sector of the economy is thin or sometimes non-existent, now that what the classical economists of the past would have believed. And this is a logic used by SARP to buy government in the secondary market with a potential to continue to simply fund speculative investments or short-term investment.
Thanks, Khadi. I see there's a hand raised by Tabang. Comrade Tabang. Comrade Tabang.
Oh, thanks, Comrade Te, and thanks, Prof. Malikane, for the presentation. So I just wanted to ask, in view of the current framework, what is the Treasury's thinking behind why it's better to borrow from financial institutions, international financial institutions, than to do QE, quantitative easing. So that's the first one. And the second one has to do with this issue of the debt, the public debt ratio. Also, I mean, the money is, it's not like the money is going to leave the country or whatever. It's going to circulate in the economy and probably even have a multiplier, and even generate greater value if it's spent, domestically. So why are they so opposed to the debt ratio? I mean, what's the issue with that? I mean, we saw with the Great Depression that, in fact, I think the GDP GDP debt ratio, they allowed it to go to about 200% or something like that. So why is it that it's seen as a problem, as whereas historical lessons can show us that actually you can do that and still recover? Thanks, Comrade Steve.
Thank you. Comrade Chris, and then Comrade, we will be welcoming hands for questions or even comments for the discussion. Comrade Chris.
Okay, just to start with the Comrade Tabang, what is the logic of Treasury going to borrow abroad? And so that the first question, that's the first question. The Treasury's economics, or their understanding of how the economy works, is that spending needs to be financed by savings, right? So there needs to be a pool of savings sitting somewhere from which government can pool and use that to finance the spending. So they did their calculation according to them, and they saw that the total national saving is not going to be sufficient to finance this government spending, projected government spending, right? So as a result, they say, okay, we are going to go outside and look for other economies or other institutions that can lend us money because we don't have sufficient saving to finance the spending we have. So their view is that it's like their view is like they view government as if it's a household. And this point has been made by Comrade Asker last week. This thing of viewing government as if it's a household. In order for you to spend, you need to use your savings. If you don't have savings, you need to go and borrow from someone else. So the country as well is like that. But the countries do not operate like that, because countries have got power to create their own their own currency, right? So a government can spend more than it collects in taxes and then use its currency to finance that spending. It does not have to borrow. In my view, the only limit to that is inflation. Is when government spends the money, pushes up demand, and finally demand meets up the barriers of capacity production. That's when inflationary pressures begin to build up. Then you stop, you reduce your spending so that you align, you don't become too inflationary. That's the only limit. Other than that, government does not operate like a household. That's where the fundamental problem is with the economics of Treasury, including the economics of the Reserve Bank. So the reason why we're going to international financial institutions is because we don't have enough national savings to finance government spending to respond to COVID. The debt GDP ratio, why are they so opposed to it? They are so opposed to it because in their thinking, if government borrows, right, again, if government goes and borrows in South African markets, government will take money from the private sector. And there will be a liquidity shortage in the private sector, which will drive up interest rates. They will be crowding out. Because if interest rates are high, it means that the cost of borrowing for investment by the private sector the cost of borrowing by the households to finance their own expenditures will be high. So private sector expenditures will go down and public sector expenditures will go up. These things will cancel each other. So there won't be any growth impact. On top of that, because your debt will be higher, your risk premium will be higher as a result, and your cost of borrowing will be higher, you will be downgraded. So that is why we need to keep the debt GDP ratio down. That's their logic. But all of that, as I've argued, the fact that our debt GDP ratio is at levels where it is, and according to them poses a threat to fiscal sustainability as they claim, is an indication, in my view, of macroeconomic mismanagement, because we should not be having so much debt to begin with, right? We could have used alternative means of financing. I'll give you an example. Treasury in the early 2000s is the one that allowed South African pension funds to basically take government bonds, sell to foreigners. 37% or so of government bonds were sold to foreigners by our own pension funds. In return, the pension funds got dollars, which are sitting outside the country, you see. So you've got dollars sitting outside the country. Our debt is now 40% foreign owned, right? The moment we move, the foreign owners of the debt want to dump the bonds and leave the country and create instability. It was created by Treasury itself, what I call the macroeconomic mismanagement, which was actually the whole agenda to tie the country to neoliberal policies. So that's why they're opposed to the debt GDP ratio in their thinking. It drives up interest rates, increases the risk premium, and it lowers the growth in the long run. And then, the transmission mechanism, is there, and it's interpreted in various ways. For example, the impact of changes in the interest rate, in the repo rate by the Reserve Bank. How are they transmitted to affect inflation and economic growth, right? Those channels through which the changes are transmitted. That is what is called the transmission mechanism. So there are transmission mechanisms that are at play in the economy. And what we are arguing, or what we are calling for, is that more channels of transmission, more direct channels of transmission, like direct credit allocation to DFIs. It's a channel that must be open. DFIs should not go via the channel of the private banks for them to acquire funds. Why? Because they need to directly access the funds from the Reserve Bank. So open all the channels and then let the economy operate at that level. Right? So that's what we are calling for. So some channels are working, some channels are not working, some channels are deliberately blocked, because of the policy framework that. So that's the story there. And then lastly, the Comrade Ayanda, the state bank. Why do we need the state bank if the Reserve Bank can lend directly, right? The state bank, must remember that the state bank will be playing at the same level as commercial banks. And more than 90% of money that is in the economy, circulating in the economy, is not created by the Reserve Bank. It's created by commercial banks, right? Because if you want to see how it works, basically you go to a commercial bank, you ask them for a loan. What they do, they approve you for a loan by immediately opening a deposit account for you. So all of a sudden, when they approve a loan, all of a sudden you go to your account, you see the amount that they approve for you, right? They just created money like that, out of nothing. And the power to create money out of nothing cannot be left wholly to the private sector. That is why it is difficult for a provincial government even to build a school, get money to build a school, than it is for a group of business people to build a mall. You see, the power to create money by the private commercial banking system is abused in a non-developmental way. So the role of the state bank is to play in that space. If the private commercial banks decide, for an example, to say, oh, government is too risky, So therefore, we are increasing the interest that we charge on government bonds. The state bank can step in and put discipline and say, no, government is not risky. We are prepared to create money as a state bank to fund government at an interest rate that is developmental. So everywhere in the economy, there needs to be that disciplining force that is in place. Same thing with the insurance companies. I mean, one of the things that we cannot allow to, and it's a debate that we still have to have, comrades, the dominance of the private sector in insurance, particularly medical aid. At the same time, we've got the national health insurance system that we want to put in place. But the health, the insurance, the medical insurance is dominated by private medical aid, right? So we need to begin to say, how then are we going to fund this national health insurance system if the private sector is in control of this medical insurance system? Well, if we were to ask me, I'm more, you could say that I'm more leaning towards pushing the limits of the capitalist system. Well, to say wherever the private sector is dominant, there needs to be some state to play a role there to discipline. Otherwise, left on its own, it can be a monster, right? So that's the story with the insurance. And just to underline, I think it was about 5 years ago, I tried to study the degree of state ownership of insurance. I found that in India, the state is dominant in owning the insurance industry. And that also adds to Indian public debt being almost 99% Indian owned, you see. So the state insurance is owning the Indian government's debt, but it's owned by the state. The State Bank of India is owning government debt. The State Bank of India is also lending to government in a developmental way. So at the end of the day, we've got a state network that is financing development without that much. I mean, they can downgrade India and do whatever, but the system is robust because they control their own financial system. I think I've.
Thanks, Comrade Chris. Thank you very much. Yeah, this is quite useful and quite informative. We have Comrade Reg, who's been trying to raise a hand. Comrade Reg. Comrade Reg.
Yes, yeah, thanks, Comrade Professor. I think it's an excellent exposition of what a state can do, and indeed what states have done. By the way, mine is a comment with just perhaps one or two other observations. I think for leadership, Alex and a few others, if we look through the theme from Comrade Rob's presentation to Prof here, we see that it seems that there are two lines that are emerging. The defunctness of the entire framework. I think the professor has basically put that together, that the framework is defunct. But I think also the fact that for us to change the institutional makeup or the macro institutions are such that they have to change too. These are coming through right across from the beginning up to now. Perhaps indeed the professor is correct in saying that we need a large network of state institutions counterbalancing, if you want, the private sector. Because after all, we are a developing country, isn't it? I mean, it just makes that sense. You know, the funding, as he put it, is really in the control or in the hands of the private sector. So, yeah, I think that exposition, Prof, is is excellent. And thanks again, comrades, for that that good work. But the structural reform issue, Comrade Prof, if you can just add a bit on there. We've seen the Minister of Finance, quickly talking about structural reforms. I think, frankly, that requires a slightly robust engagement from you, teacher, Professor Malikane. Thanks.
Thanks, Comrade Reg. Stembiso is back. There he is.
I've just come back now. Yes. Do you have any other comments, comrades, or anyone who wants to make a comment?
Comrade Langa's hand is up.
Sorry?
Comrade Langa's hand is up.
Oh, Comrade Langa. Gambo.
Yeah, thank you, Comrade Chris, for a very well thought, very clear presentation. I think what I take from the presentation is something similar to what Comrade Juma said some few weeks ago, that indeed we do have the resources in the country to pursue a progressive line of development. The question maybe is political will. And I think what I take from the presentation today is the kind of architecture that we may want to put in place, at least from a macro and a micro point of view. And I think that that's also very, very, very useful. What I would want to say, maybe to ask a question, which sections of capital do you believe would be most happy or comfortable with the kind of perspective that you're presenting? Because for me, we from the progressive movement, the working class, popular movement, etc., are fairly comfortable with the kind of perspective you're sharing with us. But the question is, how do we win over other sections of capital? And which sections, in your view, would be amenable to this? Or let me rephrase the question and say, other than finance capital, which other sections of capital would be opposed to what you're saying? Because I think, in my view, only finance capital would find problems with this. That would be the first question. I think that relatedly also, I thought that indeed you do hazard possibilities of developing instruments that we can use to chart, development, to secure funding, etc., to rethink the role of the Reserve Bank, blah 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 blah. I find that useful, but I thought that you didn't put much attention to the path of capital accumulation, to the forms of capital accumulation. How do we use this capacity that you've been referring us to impact on capital accumulation? Because we don't just and how do we proceed in that way? Because I think the major gap in how we've been thinking about the economic development in our country has not been to put measures that can link tightly with the forms of wealth creation. So I wanted to maybe get your comment on those. Thanks, comrades.
Thank you, Comrade Langa. There is Comrade Asker.
Well, thank you. Hi to everyone. I like to thank Chris as usual. Insightful presentation, and I think I'd like to make a comment about the importance of the point that Chris is making and the centrality of the issues that he's raising in terms of where the debate needs to go. If you look at the number of recent documents that has come out, For example, the Business for South Africa put out a new document about the solution to the, the roadmap for the going ahead. Yesterday, Colin Coleman made a presentation, has another document talking about the planning for after COVID. If you look at these, and obviously with the government documents as well, there are a lot of attempts to present that a solution, that there is a solution without really touching the policy framework. That it is about industry reforms, that it is about some regulations. If we get that right, if we get some of these, this right, it will all, and they all end up now, it's become, customary to throw this 5-6% or 5 million or 10 million jobs, not showing how these things will be created, but using it because they cannot get, support unless they say that supposedly these things that they're proposing will achieve that kind of goals. So there are a lot of attempts to tell the public that there is a way out of this crisis and out of the larger crisis of joblessness and poverty and inequality without really dealing with the monetary policy, without dealing with the fiscal, without dealing with it. And I think that's why it's so important what Chris presenting is that it shows that it is such an important to unlock that developmental potential of the country. It's very important to revisit the whole economic policy framework. Now, if we can get lost on these sectoral policies and different things, but I think they all fall short significantly in showing that what they propose actually make a difference, significant difference in job creations, in even economic growth. If you look at the starting from Treasury document, they fell short. They said at best in 10 years they create 1 million job, 1 million job over 10 years, and a growth of about 2%, which was badly calculated and full of mistakes. If you look at the Business for South Africa, they're talking about we're going to get to 5.2% growth. We're going to have unemployment rate 15%, but they have no path, no roadmap to those numbers. They are basically creating these numbers, but the main thing is about those regulatory, fiscal discipline, all of those stuff that we have heard. So I think it's very important to, in my view, what Chris is saying, that to see that change, that new liberalism that has institutionalized especially in the banking center, in access to credit, in terms of interest rate, exchange, all of these. This is the change has to be bold, has to be substantial. It is not tinkering that is needed. Otherwise, the numbers are all, none of those that are being said is going to be realized. Those, bigger goals. Thank you very much.
Thank you, Comrade Aska. Before I give to Comrade Chris, and we try and round it up soon, I just want to find out if there's any other comrade who wants to make a comment before Comrade Chris takes over. Again, any comrades here? Comrade Alex? Oh, okay.
No. Comrade Stay, I do not have a comment. Perhaps let me use this opportunity to thank Comrade Chris for a well thought out presentation. And for the proposals contained in his presentation. In particular, the proposal for a state bank, which the SACP has broadened to refer to a state banking sector, and not just one state bank, but a state banking sector which is a developmental banking sector. In South Africa, we do not have either a developmental banking sector or a developmental financial sector, broadly speaking. Yet, we are talking about implementing a national democratic revolution, which is a process of structural transformation of the economy and society as a whole. I mean, there is an article I read today about problems that emerged from the loan guarantee scheme established by the National Treasury and the South African Reserve Bank. That loan guarantee scheme, as an example, is channeled through the commercial banks and is guaranteed by the state through the National Treasury. If losses occur in that scheme, there is a cap. Beyond that cap, those losses will be absorbed at taxpayers' expense, right? Now, you have finances released by the central bank, partly, and fully guaranteed by the National Treasury on behalf of the state, channeled via profit-seeking commercial banks. All right. This example is about state intervention to mitigating or to stopping a meltdown with a focus on small, medium, and micro enterprises, which relates to the question asked by Comrade Langazita about which sections of capital can support a progressive agenda and so on. The absence of a developmental state banking sector means that public resources are not only channeled through commercial banks, means that a key monetary policy transmission channel is not only, commercial private banks, but that, the trillions, or at least the billions up to $1 trillion and more of state funds are banked with commercial banks. One of the comrades in one of our sessions posed the question, imagine if that entire amount was banked with a state bank or a developmental state banking sector. Think about the benefits for development and transformation as a whole. So that key demand we shall have to advance, deepen, and widen. The commercial banks, as Comrade Chris demonstrated, receive money from the central bank at a low rate, the repurchase rate, and there are other low rate facilities. And it attaches conditions to that money and raise interest on that money and makes it available to the non-banking sector and to ourselves as citizens at a very high rate. So the commercial banks are sort of, in inverted commas, middlemen. No, they facilitate money from the central bank and take a cut by means of this interest and so on. I mean, we do need to problematize the entire infrastructure, the entire architecture. And the best way of problematizing the entire architecture is to challenge it, because there are resources, but these resources are in the hands of commercial banks, which do not serve a developmental purpose, but serve a profit-making purpose. So I wish to really thank Comrade Chris for elaborating that, and for also pointing out the developmental role, widely speaking, that the central bank can play. At the moment, the central bank and the Reserve Bank are South African institutions because they are geographically located in South Africa. Not because they are driving a developmental agenda in South Africa. So institutionally, in terms of their thinking, and if you look at the National Treasury paper, Comrade Chris, that you referred to, and I wish to hammer on this, codifies the so-called or structural reforms developed by the OECD with its feet standing in Europe. And those structural reforms codified in that paper are released in South Africa without consultation. So here you have foreign institutions that play a key role in determining our policy, and that policy released to the nation without consultation as our policy. I hang on, and I just lastly wish to also thank you for hammering on the way forward. I will call it the way forward of structural economic transformation, rather than those neoliberal policy reforms that coalesce on weakening or liquidating state participation in the economy, divesting state-owned enterprises, promoting private sector participation and competition on the back of state-owned enterprises' infrastructure and their liquidation. In other words, here we have a national treasury that is moving in a direction that is diametrically opposed to that which is spelled out in the Freedom Charter. So the ANC needs to note this. The movement needs to know. Today we have been told Eskom, Transnet, this are a monopoly. What does the Freedom Charter say about monopoly and banking industries? So today we have a national treasury that is organizing against, that is waging a counter-revolution against a fundamental policy of the ANC. So I have to say this because this platform, as Comrade Reg has said, in a way enables us to develop a counter-hegemonic agenda, because we cannot continue supporting electorally people who act against fundamental policies of our movement. At some point, we have to meet in the revolution. And I see these sessions facilitating that process of class struggle. And I wish to thank the Chrisani Institute for that.
Comrade Alex, Comrade Chris, and then you can just also make your closing remarks with that.
Thank you, comrades, for the good responses and the questions. Just to talk about what Comrade Reg highlighted about structural reforms. I think the SACP has released a document really dealing with this structural reforms. And sadly, Treasury did not respond, and that's how they operate. They simply ignore. Why are they ignoring? Because they're in positions of power to ignore. So whether it's the party, whether it's civil society, they just bulldoze their way through. And now with COVID, it's difficult to organize really in the streets. It's a perfect opportunity for them to drive whatever policies they want to drive, because on the streets, it will be difficult for the working class to be organized. So we need to think carefully how we respond, comrades, in organizing the working class under these COVID conditions. Otherwise, things are moving. I mean, they're moving. And on structural reforms, just to say that, to me, they are nothing but structural adjustment program, again, and they are going to fail. They are not going to deliver what they are promising, just like structural adjustment programs failed. These two will fail. I'm aware that there are a number of studies by the IMF and the OECD punting the idea that structural reforms are actually having a positive impact on economic growth. And I think comrades must begin engaging with those papers and provide critiques, and in a way that we can mobilize the working class against people who support these reforms. Comrade Lang asked the question about the path of capital accumulation. I think if we have a developmental central bank, it will be in a position to also respond to industrial policy, because the question really is about industrial policy that Comrade Langa is raising, which is very important, because ideally what you would want is to determine your industrial structure, and then the needs that needs to be fulfilled, social needs, that social delivery needs that need to be fulfilled. And on that basis, allocate resources from the financial system to support those priorities. So a sharpened industrial policy needs to inform actually these macro interventions. The capital, the types of capital that will support this, basically the manufacturing sector, the industrial capital, they will support this, be it in manufacturing broadly, even agriculture, because they need inputs from manufacturing, and they need fertilizers and so forth. They also need infrastructure like water, because most of the farmers now, because of the collapsed irrigation systems, they are now forced to internalize the costs of irrigation into their products, but having an approach that basically drives infrastructure development, including water irrigation system, in a developmental way, that also takes away or subsidizes their costs, and that opens an opportunity for even the state to begin to put conditions for farmers to say you must lower prices and so forth. So all the types of capital that I would call industrial in the broad sense, or productive capital, would welcome this. But monopoly capital in the form of SASOLs and all of that, they might be opposed to this because of the linkages between monopoly capital and the banking system, So the big capital will be fighting, even in industry, will be fighting against this, because those ones, they don't have a problem with access to funds, because they have share ownership in the banks. There's this cross directorship that is happening at that level. But the lower ones in the value chains, like the manufacturer circle and the farmers associations, including even the Afrikaner farmers, can support this thing, because it is aimed at lowering their costs and therefore improving their profitability. So there is hope to mobilize, even to divide the capitalist class from this time. But we need to pursue. We need a more nuanced research that is centered on industrial policy and linking it to the various fractions of classes, and begin to engage those fractions in their associations and so forth to test these ideas. You know, it's important. But it would be funny for a Communist Party to be doing that, but it needs to be done to create this broad front of progressive forces. And what Comrade Asker is saying is also very important. There are documents that are coming out, Business for South Africa, all these documents, they reminded me of the early, I think it's the early 1990s when there was contestation, GIA versus the other progressive documents that were coming from COSATU and the party and so forth. That ultimately got sidelined, led to the sidelining of the RDP and the emergence of GIA. I think we are in this phase again. History is repeating itself, right? But here, we need to be shrewd. I don't know, we need to be shrewd. But what is important is that we need a document around which we can rally progressive forces. We need that document, because these documents ultimately are going to be regarded as the existing scientific documents that can inform policy. So we need a document that can, you know, rally progressive forces, a document that is well researched and analytically sound, that we can use to contest in the battle of ideas. So it's a task, Comrade Langa, Comrade Asker, and Comrade Reg, comrades here, and comrade in the party broadly. In fact, it's a task of the party. It's the task of the party as the most organized force on the left. It's the task of the party to organize this sort of document. Otherwise, it will be difficult to come out. And then, Comrade Alex, thanks for the comments as well. I would simply like to say that I appreciate this thing of the state banking sector, not just the state bank. In fact, it's a very important intervention by the party. Comrade Reg mentioned at some point the need to even build a cooperative banking system that also interacts with the state banking system, building collective forms of ownership in the various sectors of the economy. You know, so this is a concept that we need to take forward. As we develop these ideas, are we saying, for example, that how do we see community banking? You know, these stokvels that are currently existing, is there a way in which the party can take leadership in organizing them in a more structured fashion for them to be more impactful? I think we need to take it forward. And comrades, let me thank the Chris Hani Institute, and let me thank you for giving me this opportunity, for hearing out the ideas that I put forward, which are ideas that I share with many of you. They are not new ideas, it's just that I just put them together in what I consider to be a semi-coherent way. And thank you, comrades. And let's continue to be confident in these ideas. You know, let's continue to be confident in these ideas. They will come with technical terms, they will come with numbers, as Comrade Asker said, but if we are clear about the logic of our ideas and we are confident about the correctness of our ideas, we've done our comparative studies, we've studied the structure of the South African economy properly, I think there's nothing that at the level of ideas can defeat us. What is lacking from amongst us is just organization and mobilization. Thank you, comrades.
Thank you, Comrade Chris, and thank you, comrades, for this very illuminating session. Please don't mind the darkness on my screen. I'm still being load shed, and I have to be outside just to be able to pick up the network with my router. But thank you very much, comrades. I think this has been a very fruitful session, and I think 2 points that I think let's end with them. And the most key one is the one that Comrade Chris just mentioned about coalescing all our efforts to actually developing a very clear document. And by the way, Comrade Langer mentioned this point in our very first webinar, where Comrade Rob was presenting, and obviously he framed it differently. He was saying that we need a very basic, either we can say a 10 program plan or 15 program plan of very clear outlines of what we have consensus on, that then can become our basic demand. And now, as we end this session, this point is coming up again around really coalescing our efforts, and so probably after this meeting, we're gonna have to have a conversation again with Comrade Alex and the comrades and the parties, political economy technical task team around how do we consolidate warm bodies and ideas and around processes to really develop this kind of document. And obviously, as Comrade Chris was mentioning this earlier, these comrades are moving on, by the way, and they're not waiting, and so this needs to happen quite speedily, and so we have to be up to the task if really we're gonna be able to make any kind of an impact. So thank you very much, comrades. Next week we have Comrade Pat Horn and on the informal economy, and she made a quite a very instructive presentation at the Jack Simon School on Sunday, and she's going to expand on a number of those things, and it's going to be quite useful. And we have also in a principal agreement with Comrade Bususbeko to follow her a week after that. She just mentioned that she's actually going to present research that she's just completing, and so it will be quite interesting to hear the kinds of works that they are doing from the IEJ and the kind of things that are coming up. So thank you very much, comrades. Comrade Tabang and Aisha and Musa, maybe let's talk on WhatsApp, because I was thinking that we're gonna try and continue after this meeting, but I don't have power and I'm freezing outside, so I can't continue to stay outside any longer. Thank you very much, comrades, really for this wonderful session, and thank you very much, Comrade Chris. It was really quite an illuminating thing, and hopefully, if possible, you can send us the presentation, and we can be able to try and engage it further. Thank you, comrades.
Thank you.
Thanks.
Thank you.
Thank you, everyone.
Bye, everyone.
Bye.
Mashilo.
Yeah, there were some few gremlins today. And then on your side, there was this problem of electricity and bandwidth. Yeah, but congratulations, you are doing very well.
Thanks,
through these seminars.
Yeah, I was gonna say we need to talk again.
I hope you are no longer streaming live. Yeah, you are still streaming live. Stop it.